Shall we start? I'll start straight away on this. What remaining there we have to discuss. Last week we couldn't finish this, so I remind you some strategies. What are the strategies? We discussed two strategies. What are those? What are the strategies that we discussed? How many of you participate in online classes? Skip that question and go to the previous question. Okay. Spreads and combinations. What's the difference between spreads and combinations? In spreads, we buy and sell options in the same class. What does it mean, same class? Either put options or call options. Buy a put option and sell a put option. Or buy a call option and sell a call option. That is spreads. Combinations can be a mix of put and call. It's a mix of put and call. If you buy a put, you sell a call. Or you buy two, one put and one call. Or you sell put and a call. This is the basic. So then spread again. We divide these spreads into how many categories? 3. What are those? Horizontal, vertical, right. What are the horizontal? What does it mean, horizontal spreads? What is a horizontal? Strike. So you buy and sell options with same strike but different expiry. In a vertical, other way around. Different strikes but same. In the diagonal, it's combination of horizontal plus vertical. That means different expiries as well as different strikes. What are the vertical spreads that we discussed? Bull spread and bear spread. Bull spread and bear spread. What is a bull spread? The view is moderate bullish. What does it mean? We expect the price of the underlying to go up, but with some limit. Some moderate bullish. We think it will go up, but not by large amount. In a bear spread, what is our view? Again, it's moderate, bearish. What's the bearish market? Market going down. We can create bull spread either using put or forward. How do you create a bull spread? What's the rule? What do you buy? What do you sell? In a spread, what we discussed, bull or bear spread, you buy one option and you sell the other. In a bull spread, what do you buy? What do you sell? Buy call option, sell. Go back to basic. This is a vertical. So, and a spread. If it is a spread, if you buy a call, you sell a call. Then what is the difference? Should be in the strikes. So there should be two strike prices. Then one should be low, one other one be high. Then which one you buy, which one you sell? Sell the high strike option. You buy the option with the lower strike. It doesn't matter whether it's a put or call. If it is a call bull spread, you buy a call option with the lower strike, you sell a call option with the higher strike. If it is a put spread, you buy a put option but still with a lower strike, and you sell a put option with a high strike. What is the shape of the payoff line for the profit line in the bull spread? What is the shape? Whether it's a put or call, the shape would be like this. This is the maximum loss that you would incur. What is this loss? This is the premium. Why do you have to pay a premium? You buy a low strike option, then you have to pay a premium. You sell a high strike premium, then you collect the premium. But premium on the low strike in a call option would be higher than the premium on the higher. So the net would be the payment. Even in put option, the shape would be the same in the profit diagram, but the argument may be why. If it is a put option, which one is more expensive? With the lower strike or with the higher strike? In a put option, which is more expensive? Lower with the lower strike or the higher strike? Lower strike, expensive. Why? What do you get in a put option if you are a buyer? Right to sell. When that price is very low, would it be very costly or cheap? It would be cheap. So therefore, when the strike is low, premium of a put option is low. When the strike is high, premium of a put option is high. So in that case, payoff would be different. But once you net, in that case, premium would be positive in a put spread. But when you combine it with the payoff of these two combinations, the shape of the profit diagram would be the same. Payoff diagrams may be different, but the ultimate result, profit diagram, would be the shape, would be the. It's about bull spread. Then what's a bear spread? What's the bear spread? What do you do there? Still, you buy a call and sell a call, or you buy a put and sell a put. But the problem is with different stripes. Which one you buy, which one you sell. The opposite of the bear. What did you do here? Sorry, opposite of the bull. What did you do here? Buy low, sell high. Same. Buy high, sell low. Then the shape of the profit diagram. Shape of the profit diagram. For bear spread, just like this. This is flat. For bear, it would be like so. Don't try to remember these shapes, but understand how to get this. So these are the things we discussed last week. And in horizontal, what do? We buy a call and sell a call, but with different expiries. Why do we do that? Our VV is on what? In this, in vertical, we have the directional. We think about the direction of the market of the underlying asset. Whether price will increase or price will decrease. In horizontal spreads, it's not a we want the direction. Then volatility. This will be based on volatility. What would happen? Volatility increase, premium of options or value of option increase or decrease. When volatility increase, premium increase for a put option or a call option. When volatility increases, value of option increases. Is it only for call options or put options or both? Simple MCQ question. You may expect this sort of questions. At least. In MCQ, in your paper, there will be 4 options, choices. One is, the question is, the volatility increase, value of option increases only for call options, only for put options, for both put and call. C, none of D, the last option, none. What's your answer? I heard someone gave the answer. Both, yes. Irrespective of whether it's a call option or a put option, when volatility increases, value of the option. So what are the factors affecting option value, option prices, option premium? Strike. What's the relationship? If strike increases, if the strike price increase, what would happen to the premium of an option? Premium of an option. Is it increase or decrease? Again, increase, decrease, both. So you can't say both. Unchanged. If you can't remember what I just mentioned here, when deciding the premium, now you should know the answer. Just before in a bull spread, I mentioned you buy a option with a lower strike and sell option with a higher strike. I said in a call option, you pay a high premium to the one that you bought and you receive a small premium for the one that you sold. Why? Just because of the strike difference. When you buy a call option with a lower strike, the premium is high. When the strike goes up, premium goes down. So in a call option, this strike have the negative relationship. Higher the strike, lower the premium. But in a put, it's other way around. When the strike is high, premium is high. What is the second? Sorry, expiry. That is time. Time to maturity. What's the relationship? When the option is with a long maturity period, premium high. Why? Huh? It's more uncertain. The risk is high. Therefore, this is class 4. call and put, and we discuss other concept called time decay. Can you remember? Even last week we discussed. What is the third variable? Volatility. This is always positive, whether it's put or call. When the volatility increases, value of option increases. Then what else? What are the other variables? You don't have the handout with you. No. You have. Interest rate. What's the relationship with interest rate? When interest rate high, what would happen to the option premium? For call options, it's plus. With options, so this is like doing a revision on options. So I'm not going to discuss it again in revision class. However, we'll stop that. We'll go back into this. In horizontal spreads, we welcome the volatility. Depending on your view, either you buy a short dated option and sell a long dated option. What does it mean? Short dated option? Option with a short maturity. Long dated option mean with a long maturity or long expiry. Which one is high volatile? Remember, option value and the volatility. Two different. Long maturity option value of the option may be high. What does it mean? Volatility. If price increase or price decrease, whether it's a big amount or a small. Which one is more sensitive? Short end or the long? Short. If you remember the fact, this concept, time decay, you know why. When it gets close to maturity, it's like that. This is the maturity. When it gets closer, price goes down very rapidly. This is the time decay. At the inception, price is high, assuming all other variables remain constant. When it gets closer to maturity, price drops very rapidly. So this end is highly volatile. That is horizontal. Then diagonal. What do we do in a diagonal spread? It's a combination of these. We buy options with a certain strike and certain maturity. Then we sell another option with another strike and another. Then you will expose to both the direction and the volatility. So that's the summary what we discussed. We discussed these combinations as well. What are the combinations we discussed? What are the combinations we discussed? We discussed two combinations. What are those? Straddle and a strangle. What do you do in a straddle and a strangle? What do you do? You want to go low by this straddle. What do you do? So this is the summary. We discussed this one as well. These two. What is a straddle and what is a strangle? What do you do here? These are combinations. So then what do you do? You combine call option and a put option. In a straddle, what do? You buy a call and a put, you buy a call option and you buy a put option with same strike and same strike. When we discuss this, no need to say on the same underline. This is on the same underline. All these things on the same underline. So then what would, okay, in a strangle, what do you do? Till you buy a call and a put with the same same what? Expiry and what? The different strikes. In a straddle, you buy a call, you buy a put with the same strike and same strike. In a strangle, you buy a call and a put, but with two different strikes, but with the same strike. When you do this, what would happen? If price goes up, so this is the same strike. You have bottom, call, and a put. If price remains here, price. If price remains below the strike, what do you do? Now you have a call option and a put option. What do you do when on expiry date the price remains lower than the strike, below the strike? What do you do? Sorry? You call option, exit. Put option, exit. Fine. When you buy a put option, what do you get? Right to sell at the strike price. When the market is lower than that, you take that advantage. You sell it at the strike price when the market price is somewhere below. So you exercise your put option. There's no value for the call option because you can buy at a lower rate than the strike. So you exercise your put option. That means you gain something on this put option. If the price remains somewhere here, your put option is no value. There's no value for the put option, but call option is in the money. You exercise your call option. So basically, when you buy a call and put, when you buy a call and put with the same expiry and with the same strike, you don't have to worry about where is the price. Either it goes down or goes up, you get some. So the payoff diagram will be like this. This is the strike. This price. This is payoff. This is payoff, not the profit. Why? When the price remains below, you exercise your put option. You get this difference as the payoff. This goes further down, what you get increases. When above the strike, you collect this difference through this hold option. When price goes up, what you get, you pay off. Either way, you make a profit. Oh, sorry. You get a payment. So you won't get this for free. You have to buy a call and buy a put. When you buy a call, you have to pay a premium. When you buy a put, you have to pay a premium. So you pay two premiums. So therefore, this would be costly. So you pay a premium, high premium, then profit diagram would be like this. From this payoff, you deduct the premium what you pay. So this is the payoff, right? Sorry, the red color one is the profit. Right. Again, there are two break-even points. To make a profit, either the price should fall below the strike by an amount equivalent to the total premium that you paid. This difference is the total premium. The same thing is valid for the upside as well. To make a profit, the price should go above the strike equivalent to an amount of the total premium. Otherwise, it's a loss. Clear? Okay. Answer the question. Why do you use this strategy for one case? Why do you do this? To manage the risk. Which risk? But if you don't do anything, you don't lose. You do this only then for the maximum loss. That's the premium. The maximum loss. That you pay. But if you don't do this strategy, you don't lose anything, even the premium is there. Why do you? What is your view? we are neutral on the market direction. It goes down or goes up. Either way we make up. They want to be. Market to be stable. Opposite. What is the opposite? Volatile. The market volatile, what does it mean? We don't know whether the price is going up or going down. It can be either way, but market will move. So in that case, we make a in a strangle. What do? We use different strikes. Usually, strike of the put option is lower than the strike of the call option. Then what would happen? Instead of this single point, we start to make profit on the put option somewhere here. We start to make, get payoff somewhere here because there is this strike for the put option. Now we have two strikes. We start to get a positive payoff only if price remains below the put option. If price remains somewhere here, what would happen? In between the strike of the put and the call, what would happen? You have got a put with this strike and a call with higher strike. Price remains somewhere here in between these two strikes. What would happen? Will you exercise any of these options? No. No value. Price is higher than the strike of put. So no value. Meantime, price is below the strike of the call. So both are out of the money. You won't exercise your right. So you won't get anything here. But when price falls below this strike of the put option, you start to get some. Further down, to make it will be like this. On the other side, it will be like. But still, to get this, we have to pay a premium, but the premium may be less now. Because most probably both of these options may be out of the money options, so the premium will be low. So this will be the profit side. Now, again the same question. Why do we do this? One thing, at least to reduce our cost. When we reduce our cost, our gains also low. Because now you can see there's a region when the price remains there, you won't get any gain. So just the loss of the premium. Then there's a small region, another region. Our loss will be minimized, but still we won't get any. Price has to move far away from the current levels for us to make a profit. That means, what do you expect? It's not just volatility to go up, but will be highly volatile. Price will go up or go down by a very large. Then only you make a clear. Any question? So we discussed straddle and strangle when we buy this. We buy this strategy. These are the payoff and profit diagrams when we hold this. We can sell this. If somebody is buying, there should be another party to sell. What would be the payoff diagram and profit diagrams for a short straddle and a short strangle? That means if somebody forward, instead of buying, sell. Okay. Then what would be the payoff diagram? Then there's only one strike. Payoff would be like this. As a seller, but you get the negative cash flow of the buyer. If the payoff for the buyer is like this, negative of it is the cash flow for the buyer. Then the profit, sorry, seller. Then the profit at this point, collect the premium, maximum premium. That's the maximum gain for the seller. So it will go down like this. So the rate line is the if price remains exactly at the strike, the seller of the straddle will collect the maximum profit. That is the premium, which is collected. The moment price deviate from the strike, his profit start to go down. Then what would be the diagram? There are to strike price. Payoff would be like this. Mirror image of the buyers. In between these two strike prices, this game is limited to the premium character. Beyond that, go down. So both strategies are risky if you are a seller. Because either price goes up or goes down, you lose. That's it about option strategies. Any questions? Is it easy or difficult? Or is it like Greek? No, can't be because we haven't discussed Greeks. There's something called option Greeks. We are not going to discuss that. So this cannot be like Greek. If you think this is difficult, the problem is you cannot remember basics of options. You cannot remember what is a call option, what is a put option, what is strike, when to exercise, what do you mean by exercise. Correct? That's the problem. If you know what it is, then this is easy. So if you cannot remember that, please revise that. About options, basics. Any question? No. Clear. If you don't have any questions, I don't have questions now. I will ask. Shall we move into this? And for this, you need this handle. Tell me, what do you know about futures? You won't be able to answer by going through this. What do you know about futures? What is a futures contract? What is a future? Is an agreement to is an agreement between two parties to you will take some underlying asset on a future date and then agree price. Got it? This is an agreement to can say buy or sell some underlying asset at a agreed price, but on a future date. What do you mean by future? The wholesale market on last Friday. Is it for futures or not? No, right. Buy more. Transfer ownership. Wait. Friday itself. Okay. Settlement date. No. If you buy a bond today, assuming today is a working day, you come to an agreement with another party to buy a bond at a price, say 99 or 100 days. It's a forward contract. Futures contract. Or no. If you go to a boutique and buy 30 meters size toner, now is it a forward or a no? What's the difference between buying that coconut other than that Michelin concept? Buying coconut and the bond. What's the difference? Bond. don't get physical. When do you get that? You just pay to collect 1, 2 days. There's a specific settlement period for a financial pay date and the settlement. There are two different things. There's a regular settlement. For one, in Sri Lanka, it's T plus 2. Foreign exchange, T plus 2. Equity, T plus 3. In US Treasury, T plus 1. You buy today, you will be settled. So there's a regular settlement. That regular settlement date is a future date, not as same as trade date. There's a difference between trade date and the settlement. So in the futures or a forward, what does it mean by to buy on the future date? Because you have agreed today. The price is fixed today, underlying asset, the amount, everything you have agreed. Right? Bond. Price is agreed, amount of the bond is agreed, and the amount is agreed. Agreement is has been entered into today. But even in that fund, the settlement will be taken place in 2 days time. We don't consider. So in our day-to-day life, it's a future day. But we don't consider it as a future. It's the regular settlement we get or outright or it comes to bonds and things, we call it a cash transaction. Like this. In FX, cash transaction is somewhat. Okay. Then, what is the future date that we are referring in future? Any date which falls beyond the regular settlement. That is the meaning of that future. Should be a settlement date which falls beyond the regular settlement date. So futures and forwards basically the same. It's an agreement to buy or sell something on a future date with a at a specified price. We specify that price or agree that price on the trade date. Then what's the difference between futures and forwards? What's the difference between futures and forwards? Forwards are over the counter transaction. Futures, exchange rate. What's the difference? Over the counter and exchange rate. What are the differences? Yes, basically over the counter transactions are just an agreement between two parties. No any other party involved other than there may be a broker to meet a buyer and seller. That's it. But broker does not have any control over the transaction. All the terms and conditions are decided by the parties to the agreement, buyer and the seller. What is the underlying? What is the amount? What is the value date or the settlement date? Everything is decided by the two parties. But in a futures, the exchange traded product, all those things other than price is defined by the exchange. What is the quantity? What is the underlying? What is the expiry date? Everything is decided by the exchange. So standardized product. Not only that, even after when you enter into the transaction with another party, then the transaction will be separated into two transactions with the exchange. Buyer buys from the exchange, seller sells to the exchange. We call it novation. Splitting the transaction, one transaction between the two parties and the exchange. Specifically, it's not the exchange, clearing house of the exchange. So that's the basic of futures for the forwards. Then you know how to calculate a forward rate for an exchange. How do you calculate the foreign exchange forward rate? That is the futures price. What is the equation? Okay, if you like, I can give the pencil here. Somebody can comment, write the equation on the board. Plus future value of the domestic currency divided by future value of the foreign currency. Euro USD. What are the two currencies? Euro and US dollar. What is the domestic currency? What is the foreign? What is the foreign currency? What is the Is there any US citizens? No. Is there any European citizens? It could be yes. So that depends whether it's domestic or foreign. That depends. Assume okay. There should be two parties. One party is Euro, it's a European party, and the party is a US party. Then what is the domestic currency? For the US party, domestic currency is US dollar. For the European party, domestic currency is Euro. Now what would happen? There will be a fight on these terms. What's the base? Base currency and the counter which one base, which is counter? No, here. Domestic currency. This is counter. Counter currency. This is base currency. Correct? In this, what is the base currency? What is the counter currency? Euro is base currency. Dollar counter. Now this is correct. Now the problem, how do you calculate the future value of the counter currency and future value of the base currency? The concept is yes. Based on the interest rates. Okay, fine. Based on the interest rate, how do you do? Okay, now you need two interest rates. What are those? RB and RC. This is the interest on base currency. This is interest on counter currency. Now, how do you calculate the future value of counter currency? What is the amount in counter currency? Present value. To calculate a future value, you need a present value as well. What is the present value? Spot what? That's the spot rate. Yes. That's the spot rate. Then this is the present value. How do you calculate the future value? Multiplied by 1 plus R in simple terms, but you may have to have a adjustment here. Is that depending on the tenor of the forward contract, number of days. D over whatever the number of days per that part depends on the day count convention methods that you are going to use, divided by the future value of base currency. What is the present value of base currency? One, because the exchange rate says value of one base currency equals S of counter. 1 unit of base currency terms of counter currency is this. That's how we interpret the exchange rate. So therefore, what is this R? Should be R This is the counter currency. RB into E over whatever, right? Capital number of days that you need. This is the equation for the forward exchange. So in futures, you want to calculate a futures price of a foreign exchange. The same equation, the same concept will be. But today we are going to discuss how to calculate futures prices for other underlying assets. Maybe a share or equity index, or maybe a commodity, or maybe a bond, whatever it is. So this is again a revision. How to calculate the forward exchange. In other way, what is this? What is this interest? That is a benefit to the holder of the foreign currency. Holder of the foreign currency will, base currency will earn interest on that. Meantime, holder of the counter currency will get the benefit of that interest. In a way, one interest is a benefit, the other one is a cost. You keep the counter currency, give up the base currency. You get the benefit of counter currency, you lose the benefit of base currency. So it can be other way. So what we factored here, costs and benefits of two assets. Here, what are the two assets? Base currency and the pound. That's the concept we are going to use in futures price. And whatever the benefits and costs that we discuss in the foreign exchange part are monetary benefits and monetary costs. But in some instances, there can be non-monetary benefits. What are those? What are the non-monetary benefits? How many gas cylinders do you have? 2. Why? Do you get any monetary benefit? Very rare. The price goes up, but just for maybe for 1 month. That's it. But why do you store that additional cylinder at your home? You don't know why. Husband, why do you, as a husband, why do you keep additional? What do you get? Less husband. What do you get? Windows of shortage, yes. In emergency, whether the use one is over, you can just replace the other one. You get to. If not, what you have? You have thinking video available. You get the basic videos. But I don't know the having extra gas in that computer. In that sense, yes, will be risky. But yes, generally, we keep something additional possible. Another one is convenient. You have only one cylinder, whenever it's over. You have to take it and somehow you need to find another one immediately. See? So you have the convenient. But you have a big house. It is today. Do you like a big house or small? Yes. In university areas, computer speed. So better. I don't know. No, I mean, then calling because of calling.
Yeah, that 1% is losing.
You all are subject to calling. We can stay at the hotel for 14 days. After a few months. We can. Just try to find out whether you leave it now or later. I don't know. There will be a difference. Not for us. You are back to home. Probably they will allow it. But if we take into contact. Okay. It's up to you. Love you. It's about yes, gas is you were at home. So we keep those things first and not at the gas industry. Yeah, about house. Why do we have big house? Why do you like to buy a Audi or a Range or a Mercedes or a Land Rover without buying a Maruti or a I'm not. So why? Is it only the convenience? Prestige. Those are some of the benefit in a way that we expect. Even in financial markets, in commodity markets, we get there. Where do we hold gold? It depends. If you are a manufacturer of something using gold, to keep a stock, that is convenient. But when you stop the gas cylinder, extra gas cylinder, to get the convenience, is there any cost? Yes. Holding cost. Not only that, you buy it today for that 1,400, 4,500 rupees, you lose interest on that. Financial market, yes, that matters. So you get the convenience at a cost of, that's the cost. Not only that, you just store one cylinder at home on cost you for the space. But when it comes to large scale, you need storage cost. Not only that, but also when you store something, especially in industrial large scale. Security. What sort of security? This may be physical security to protect you in that. Insurance. So there will be costs like that. You store something, you insure it. So there are storage costs. You have to pay for the warehouse. So when we decide futures prices, we consider all those type of benefits as well as however you should be able to quantify that. So basically, what do we do for the spot price? Say you buy something today and you hold it for a 1 year period. But considering the benefits and costs, how do you derive a price in markets? At least to break even. You buy something, you keep it for a 1 year period. How do you factor the costs and benefits when deriving the price? Okay. Now, I mean, calculating the benefits and costs is financially convenient future. That's true. But it's not only. If there's no benefit, if there's no cost, just the future value and present. But when you have cost, benefits. Yes, okay. Assume benefits and costs are cash flows. do you make the adjustment? Benefits in terms of cash flows, pass on money. You receive, you get it. Cost, you pay. How do you adjust? The benefit. The spot price is that's the price that you pay today. Then you have cash receipts and cash payments. After that, who knows what will be the final result? Okay. You bought a land, you build a house. You stay there for 1 year. Now you don't want to assume market land value prices remain same for that period. What is the price? Now we are trying to sell it. What is the price that you ask? You may not get that. That's a question. But how do you decide the price? Say you bought a land 1 million and to build the house you spend another 5 million. You stay there for a 1 year period. How do you want to sell? What is the price? Forget about inflation in this example. Your cost is 1 million plus 5 million, then 6 million. Then in benefit, you stay there for a 1 year period. So, assuming that's the rent. And get that as a benefit. Say under 1 million for 1 year period rent, you can deduct. That may be the depreciation of the house. You add cost and deduct. So here also you do the same thing. Spot price, this is also the cost because that is the price that you pay to buy. Plus cost minus pay. That's the basic model. We call it cost of carry. You might have done yes, cost of carry model. Those who have done management cost. Yes. So that's the basic model that we are going to discuss. There will be more adjustments for these costs and benefits depending So now we are talking about the 1 year period. It's not like other our day-to-day life transaction in finance, time in method. You pay the spot price here, you get the benefit here, and you pay another cost here. But you are trying to value that asset here. Whatever the spot price is not same as the price. This 1 million is not same as 1 million. Whatever the benefit that you receive after 6 months, there's a future value for that. Whatever the cost, there's a future value for that. So all these cash flows for the cost and benefits, we have to adjust for the timing and interest. So we calculate future values and present values of all these, but the basic model is cost minus benefits. Clear? And this one is important. They have mentioned that even in FX forward prices of futures prices does not reflect the market perception on the what would be the price of that asset in future. It won't give any. If you can remember when I explained that FX forward equation, I mentioned that it is a arbitrage free method. That's why we calculate the present value of base currency and the present value of counter currency, which is equivalent to the base value, base currency amount. $1, 180 rupees, whatever the equivalent, we calculate the future values. Then only we make them similar and get that equation. That is to avoid any arbitrage. So even in futures is again as a forward contract. So this no arbitrage principle is followed. So this is a very simple example. You can see cash price, September futures price, December futures price. Assume we are in somewhere August or July before September. Otherwise, September is now history. Assume we are in somewhere July or August. Cash price means you have to buy the outright market. Cash market. That's the price. But September futures price 470. December futures price 433. With the time, price increases. Futures price. This does not reflect that we can expect whatever the underlying. We cannot expect the price in September will be higher than the price in August or July. Or price in December will be higher than price now. That is not the case. The difference is whatever that benefits and cost adjustment that we get. Basically, these are the things, as I explained, what we factored into the equations. We have foregone interest and storage cost, whatever interest is also a cost, foregone interest is also a cost, whatever the cost and benefits. So first we factor only the cost. So the result is that anyone wanting to deliver of the asset in September will be willing to pay the higher price because they are earning interest on their funds in the meantime and not incurring any storage. Say that gas cylinder, you buy it today, keep it for 1 month period. To buy this, you pay, you incur a cost. Then you forego your interest income for this 1 month. So if you don't want to buy it today, but postpone it until this day, you should be able to pay this price and this interest on this day. In financial markets, that's how because today you enter into a transaction to buy on a future date, so you save your money. Instead of buying it today, you save your money today. Then you earn interest. Other party forgo on that. You have to compensate. The other party has to incur storage. You have to pay for that as well. Okay. You might think in my this example, we don't pay any. So you buy gas cylinder today, or in 1 month time, you pay the same price. So there's no difference. So the interest component or nothing is added. Right. Say today the price is 1,500. Even after 1 month, we expect to buy it at 1,500. Correct? But what would happen? In between that, price can you take that risk. But if you go to the gas shop or whoever, say, I want to buy a gas cylinder in 1 month. Okay, I'll give you this. You just pay cash. Or he will you comment anytime. But at the prevailing market price, he won't agree to give it 2,500 even after 1 month. So when you enter into a forward transaction, you eliminate that risk, the price increase. But it's not for free. You have to pay for these interest costs, storage cost, and things like that. On behalf of us, they do that, they incur all those. So that's why the previous example, somebody who wants to buy that asset in September instead of July is willing to pay a higher price. However, that depends on the cost and benefit, net impact. If the benefits are higher than the cost, because we had cost minus benefits. If this part is high than the cost, what would happen to the futures price? It will be lower than the spot price or today's price. That's why if you calculate USD JPY forward trades are lower than the spot rate. But if we calculate USD LKR, forward rates are higher than the spot. Why? In this pair, LKR interest rate is high. In this pair, USD interest. In this, holding dollar is beneficial than holding yen. So the future price is in this pair, holding dollar is costlier. Sorry. Yes, holding dollar is costlier than holding LKR. Because why? If we hold dollars, we get low interest. If we hold LKR, we get high interest. So therefore, it doesn't mean that the futures price will be always higher than the spot or the cash price. It can be high or so. Basically, in financial markets, all these costs will be considered. It's called cost of carry, and there will be benefits. In financial instruments, specifically dividends. In equity, you may receive dividends. It's a benefit. For bonds, you get coupons. That's the interest income. Not only interest expense, interest income. Those will be considered as benefits. So arbitrage p-value, as I mentioned earlier, is derived based on the fair value of the futures, based on the cash price plus cost of carry. Indeed, this is net cost of carry. That means cost of carry minus benefits. So this is an example. Cash price 1,250 sterling. Yes, this is on a equity index. Equity index. If you have to buy the index, 1 unit of that index, you have to pay 1,250 now today. But you don't want to buy it now. You want to buy it in the future. If you have to buy it today, you have to spend 1,250. That means you forward interest 6%. So then, based on that, what could be the fair value of a 90 days futures contract? Cash price is 1,250. Interest cost on that 1,250 for 90 days would be 90 over 365. Remember, this 365 because of it's in the sterling form. UK market day count convention is 365 days per year, the money market. So there will be a interest cost of 18.49. Therefore, there's no benefit, no dividends, assuming no dividends between that 90 days on that equity index. So futures price would be the initial cost, the cash price, plus the foregone interest. 1,268.4. That is the futures price. Okay. If you buy that asset today, you have to pay 1,250 and hold it for 90 days, then you lose the interest income of 18.49. So if you have to postpone that without buying today, buy it in 90 days, you have to pay that for to be fair with the other part. Otherwise, there will be an arbitrage. Okay, think about it. We'll take a break. 15 minutes. Think about it. After that, I'll explain. In this example, how can there be an arbitrage? Any questions? Any questions? No. Oh, yes.
What's the interest rate? So that is the cost of funds.
Interest rate? Yes. What is the market prevailing interest rate for 90 days? Yes. Because this contract is only for 90 days. The applicable interest rate would be interest rate prevail as at today when you enter into a transaction for a 90-day period. If it is a 1-year contract, it should be 1 year. So if you have to calculate a 90-day forward exchange rate, dollar sterling, what's the interest rate that you use for sterling? That's the 90-day sterling interest rate. Yes. In this, yes, you can consider this 18.49 is the rate. Forward point. We don't call it. In FX, we can call it soft points or forward points, the difference between forward rate and the spot rate. Forward points. Yes. Now this is at a premium or discount. You pay more. But the problem is what is at a discount, what is at a okay. So therefore it won't apply. The concept is in FX, a dollar rupee, we say rupee at a discount. So we pay more to buy in future. Same thing here. Because the cost in that cost of rupees is high compared to the benefit of dollars. Here, cost of this cash is high, so we pay, our costs are high, so we pay more. If our benefits are higher than the cost, we pay less in the future. In the dollar yen transaction, our benefits are more than the cost. That's why we pay less for the. That's why it's at a premium. Yen is at a premium in dollar yen transaction. Dollar rupee transaction rupee at a discount. So basically, whether we get a net benefit or a net cost. If it's a net cost, it will be added. If it's a net benefit, it will be zero. Anything else? Not, we'll take a break. 15 minutes. No. What do you expect next week? You don't have any questions? Okay. Still, it's not decided anything, but probably then, depending on the circumstances, we may have to change the schedule again. Let's see. Maybe go back to online. But whatever it is, whether it's online or physical classes, next week or maybe quarantine, third option. Uh, Next week it will be about regulation. That will be the day. We'll let you know whether it's online classes or yeah, there will be few calculations like equity ratios and things like that. But mostly, yeah, like sort of code of conduct, there's a regulation issues by central bank. How to regulate things like that. Next week, most probably. No, next week definitely it will be regulation. If there's any class, whether it's physical or online or whether there will be, depends. That's about it. Any questions on this? No. Any questions on assignment? No. Should be, otherwise when I ask whether there's any question you should ask. Is there any question on assignment? Yes or no? Yes or no? Don't know because still you haven't read the they can't tell. So when shall I start this? If I give the example, it would be like giving the answer. Huh? Oh, it means old. It's not intention or like that. So, anything else? So, let me check what the transport. They are all. That means you don't go home. That's one note. Too much, but some. I forgot to mention that last two questions we received 500 words. Maybe 500. Hmm? No, no. 1,500 for the first question. Part A, Part B, 500, 500 each. But it's not hard and fast. You want to mistake some otherwise the answers. So you may lose your focus. Even you will go. And the most important thing is don't copy among yourself and from the net. Don't do that. I can show you last time group assignment. I show them this is your thing, this is the source. One thing, the language in that assignment is very familiar. I'm pretty sure that's central language. Website there. And these features and things like that. So don't do that. Just you refer. Referring is different thing. But you can set up it. Read it. Scan it. Then so okay. Don't copy it. To save time. You can save time at the cost of 20 marks. Anything else? We will start this. Now, according to this example, futures price should be 1,268 and 49 pence. 1,248 pounds and 49 pence. Assume instead of this, futures price is 1,270. In the market, this futures is trading at 1,270. Cash price is 1,250. Interest rate is 6%. That is given. In the market, futures is trading at 1,270. When we do the calculation, it should be 1,268 and 49 pence. There's a mismatch. That means there's an arbitrage. What is the arbitrage? So what we have to do, compare the market price and the theoretical price. Which one is expensive? Market price is expensive. Market price is higher than the theoretical price. So what does it mean? This is overvalued. When do you see something overvalued, what do? You sell. Therefore, you sell the futures at the market rate. You sell the futures at market rate. Then what do? To explore this arbitrage. Buy. Buy where from? How do you buy? If you go to the market and ask the price to buy, then they will quote 1,270. But you want to replicate that 1,268. What do you? Intend to contract to do what? That's what you have entered. You have entered into a contract to sell whatever the underlying in 90 days. What do you do? According to this contract, what is your obligation? according to this contract, the moment you enter into a futures contract to sell the underlying in 90 days time, what is your obligation? You have to deliver whatever the underlying in 90 days time. How do you hedge it? You can wait until 90 days, buy it from the market and deliver. But what's the risk? If you wait 90 days, so you have to buy it at the market price. You don't know what would be the market price. Instead, what you can do. So it's not a hedging. It's not a hedge. You keep your position open. You will get the market rate. Buy today at the spot rate. Buy today at the spot rate. Then keep it for 90 days. How do you buy? From where do you find cash? To buy this, what do? You borrow. $1,250 for 90 days at 6%. You borrow £1,250 for a 90-day period at 6%. Use that cash to buy the asset and hold the asset. In 90 days time, what do you have to do? In 90 days, after 90 days, what would happen? You have the asset now in your possession. Meet this obligation. That means deliver that asset. And receive how much? After 90 days time, on the futures expiry date, what do? You deliver the asset to the futures buyer, what you bought futures contract, deliver the asset and receive 1,200. Anything else that you have to do? You have to pay to the lender. How much? How much? You have to pay only 1,268. What's the difference? Huh? You receive 1,270. You pay only 1,600, 1,268. There's a difference. What is that difference? It's your profit. What is there any risk? No, no risk. But still there are risks. Yes. I'll explain that. But here we don't take any market risk. I'll qualify that. Whatever the market movements in between these, whether price increase, decrease, interest rate increase, decrease, whatever happen, this is guaranteed that 1.51 on profit. It is guaranteed. You don't take any risk, you incur the profit. So therefore, the market cannot behave like this. If the futures price deviates from the theoretical price, there will be arbitrage opportunities. Then what would happen? People will start to buy the asset then what would happen? Price will go up. Meantime, they will start to sell futures. Then what would happen? Sell futures price comes down. One more. If you buy the asset, you have to do this transaction. You borrow money. Even you use your existing funds, that means in the system, then loanable funds goes down. So interest will go. Everybody tries to borrow and buy. For price increase, interest increase. So in that sense, this price will go up. On the other hand, this will go down. So it will come to an equilibrium. So therefore, there won't be arbitrage opportunities in a fair market if information are available. There's no symmetry in that, no frictions in the market. In a such market, it won't happen. That's why this model works. Clear? What are the risks? Even though I said there's no risk, there are few risks. Yes, counterparty risk is there. Futures contract, yes, fine. Maybe in the exchange, there won't be any risk. But you may not be able to borrow. Even you buy, the party who sell may not deliver. But it's very, very low risk. Generally, we call risk-free. That's why we call it arbitrage. This is risk-free profit. What would happen instead of 1,270 if it is 1,265? Now the market is, this one is undervalued. Then what do you do? Buy from the market. What do you buy? What do you buy? What is undervalued? What is undervalued here? Huh? You said that when the futures market price is 1,265, it is undervalued. What is undervalued? Huh? Underlying asset. What is the price of the underlying asset? What's the price of the underlying asset? Still 1,260. What is that 1,265? Price of what? Price of the futures. Then what is undervalued? The futures contract. Futures is undervalued. Then what do you do? Buy 90-day future at 1,200. That means you have the right and obligation to buy this asset in 90 days time at a price of 1,265. Then what do you want to do? Borrow what? In 90 days time, what do you need? Enter into a contract to sell the future. You already bought the future.
At the market.
At the market, how do you? At the market, 1,260.
No, no. Then you-
Yes, how do you do that? What do you need in 90 days time to honor this contract? You need cash. 1,265, you need cash. How do you generate that? Invest 1,250. How long? At 6%. Now that's one thing. You should be able to transact at the market rate. You should be able to buy or sell the asset at this price and borrow or lend money at that interest rate. You should be able to do that to explore the. So you can see now we use just one figure, one interest rate figure, one spot price, but there will be spreads with offer spreads in spot rates as well as interest rates. So you have to factor all those things practically when you do this type of calculations. Okay, to lend 1,250 today, how do you find? How do you generate 1,250 today? What you can do? You can sell the asset at the market price, that is 1,250. Any question? To sell the asset, you should have it. Can you sell it without having it? This is the short sale. What you do? But when you sell it on the settlement date, you are not selling it for 90 days, just in the cash market. In a day or 2 days time, you have to deliver it. What do? You don't have it. Go and hide somewhere. What do? You borrow the asset. You borrow the asset. In this, remember, there may be a cost borrowing. You may have to pay something to the lender of this asset. Now this is fine. Now what do? After 90 days, on this, you receive 1,168.49. Pay 1,265 on this contract. and get the asset. You got the asset, deliver it to the vendor. So if you assume there's no cost in this, whatever the difference is, your profit 3.49 minus borrowing cost is your profit. What borrowing cost? Borrowing cost of this asset, not cash. You borrowed the asset, there may be a cost. So to do that, you should make sure the borrowing cost is less than 3. To borrow the asset for a 90-day period, the cost should be less than 3.49. If it is higher than that, you cannot. Then again, there's no reason other than counterparty risk in some. Okay. Any question? Did you get any attendance sheet? Yes. Have you signed the sheet at the entrance as well? Everybody. So there's a sheet at the entrance. Huh? This is for quarantine. No, in that I think you have to note the temperature as well. Did you? No. You just signed.
They didn't. They checked the temperature, but they didn't tell us to sign.
So everything in Sri Lanka, like the procedure is there. This in the drawer.
At least they should have been some.
Okay, so
Just
some must be there to- Okay, any questions on this? No questions. Is it clear or not clear? You don't know even if it's clear or not. Not only in the exchange traded, even a forward, you can find. You ask for a forward contract, counterparty quotes a price, and when you put your borrowing costs and all other costs, you get a price. If there's any difference, you can export. Then you take more counterparties. That's the only thing.
Like this. Typically, I ask this question because please, this case, get involved in.
Depletion case is different. He was supposed to do this. He was supposed to. I don't know whether you know the depletion case. If not, read it and watch the film as well. Depletion is supposed to do arbitrage trades on Nikkei 225 index in New York, Singapore market and Tokyo market. Two different locations. There may be two different prices. What he is supposed to do, but what he did instead of doing that, he bet on the direction. He thought Nikkei index will go up, so he bought a lot of outright futures. Even here, you buy futures and meantime you do other transactions to cover it. Then you get the arbitrage opportunity only. What he did with his speculative mind, that price will go up, the index will go up. He just bought futures, but he didn't do the other part. Then he did the exposure to the market. But the market went down, so he is incurring losses. To hide those losses, he did more trades and he manipulated the accounting entries because he's the only one. Like he did everything: trade, the booking, settlement, everything. That's what. Then the market collapsed with the earthquake. Earthquake, if I remember correctly. Kobe quake. So market collapsed. He was exposed and revealed. So then he escaped. No. Initially he escaped and only caught in Germany or something. It's not because of arbitrage. He didn't do that. He just speculative trading without.
Basically, he was supposed to do both, but he did only one. The other part.
Any other question? No. So you can do this. So you can see here the storage cost is given including insurance, but sometimes it may be a lump sum, just $50 or £50, 50 rupees, but it may be paid. Then it's like interest. Then you don't have to worry about timing. If it is a lump sum amount, then you have to worry about the timing. When do you pay? Whether you pay at the beginning or at the end. If you pay at the beginning, then you have to add that to the cost and calculate the interest expense on that. In this case, you don't want to worry about the interest on this. Here we assume this is again also a sort of interest expense. So the answer is given in the next slide. Cash price is 750. Interest only cost is at 3% for 45 days is 2.77. Storage cost at 0.05%. Sorry, 0.5%. 0.05%. Then I think there should be another zero. it's only 46 pence. Then the fair value is 753. Again, futures price, fair value is higher than the cash price just because of you have only cost. In equity indexes, so in equity or when there are dividends or cash payment as benefit, this is how do you calculate the net finance cost. Whatever the interest that you forego on when you buy that asset, and whatever the minus the present value of the dividends that you are going to receive. I think the next one is an example of that. Index is currently at 1265. Interest rates are 4.55 and the dividend yield is 2.25 per annum. Again, here the dividend is given as a yield, as a percentage. And the futures is 480. This is the summary of the information given. Cash price is 1265, interest rate 4.55, dividend yield is 2.25. So remember, this is a benefit, this is a cost. You buy the index, during your holding time, you get dividend at a 2.25%. Interest cost would be 29.09, dividend 14.38. Cash price plus interest minus dividend. This is the futures. So still you can see cost is higher than benefits. The net financing cost is positive. So therefore the futures price is higher than the cash price. If this rate was more than 4.55, it should be lower than 1,260. If the dividend yield is higher than the interest cost, then what would happen? This will be higher than this interest rate. Then the net financing cost would be negative. Therefore, futures price will be lower than the cash price. Is it clear? Net financing cost to finance the position, that means to buy that asset, what are the costs that you incur? Cost net. What are the costs? What are the benefits? To receive something as a benefit, to incur cost, the cost, then it is the net. It may be ultimately it may be a benefit or a cost. Okay. This is also same as the previous example, so we can just keep that.
That slide 22, 91 days to run means
That means the futures contract is for
only one.
only for 90.
It doesn't mean that other.
Yes, the futures contract, like today you can buy a next March future. Today you can buy. The same futures you can buy in next January as. So the remaining maturity. That's why it says 91 days to run. So many times I mentioned that futures price can be higher than the spot price or maybe lower than the spot price. In these two situations, so this situation arises depending on the net cost of carry. If it is a net cost of carry positive, this will happen. Futures price will be higher than the spot price. This is the word that I wanted to highlight here. That type of market we call a contango market. So when the futures price is higher than the spot price, it is a contango. Other way around, we call it a backwardation. When the futures price is less than the spot price. So that means when you have net benefits, of holding the asset, the futures price will be lower than the spot price. We call it a backwardation.
Stockbroker's name. Contango.
Stockbrokers.
I just check what is contango. It says the person who. I mean, his name is contango.
Maybe. I didn't know that. If you work out this example, you will get a futures price less than the cash price. Here it says 110.50 is the cash price, interest rate is 38.6%, and the bond yield is 7%. Even in Sri Lanka, if you can do bond futures now, you can see coupon on the bond will be higher than the interest rates. Coupon on the existing bonds will be higher than the market interest rates. So the futures would be in a backwardation market. If you buy a futures contract on a bond in Sri Lanka today, price would be less because your benefits are higher than the interest cost. So you work out these. So instead of calculating benefits and cost separately, the net cost is calculated as the difference between two interest rates. Same thing. Because the period is same, only two interest rates are. So it's 10 pence lower than the cash price. Futures price is lower than the cash. Benefit is in the previous one. This one, yes, because bond yield 7%. What does it mean? If if you invest in the, say, you buy a bond, you buy at the yield, so that's what is the rate of return you earn on the bond? That is 7%. But to buy the bond, you need cash. Your intention is to hold it only for 30 days. That's why we calculate it for a 30 days. To buy the bond for 30 days period, your financing cost would be 6%. But if you hold it 30 days, on the bond you will get a return of 7%. This is also almost same. Then the other concept is conversion. What does it mean? What would be the price of a futures contract on its expiry on the maturity? What could be the price of a futures contract on the expiry? Assume a 30-day futures. This is today. This is the expiry date. Whatever the price that you calculate earlier, 110, $110.50. This futures price is as at today. Today you agree to buy your sell asset at 110.50 in 30 days time. But what would happen after 15 days? Assume spot price remains same and interest rate remains same. Even after 15 days, interest rate remains same, unchanged, whatever 3% to whatever. And the spot price also remains same. What would be the price of this same future? It doesn't mean that 30 days, then it would be only for 15 days. What would be the futures price? It won't be 110.50. Will it be more than that or less than that? It will be less than that. Why? Even if this remains constant, time period is now low, then the price should go down, futures price should go down. So it will be less than 110.50. But it may be more than 110.50 or less than 110.50 depending on the spot price and the interest rate. So therefore, during that lifespan, price may fluctuate. From this to this, price may fluctuate. But what would be the price only on the expiry date, that means the last date. What would be the price?
Same price.
What do you mean same price?
150.
Go back to no arbitrage principle and think. On the last trading date of the future, what would be the futures price? It should be the spot price and that date. Otherwise, again, there's arbitrage. It's the last date of the futures. If it is, so that means you trade at the spot market, same market. You buy a futures at one rate and the spot market is different at a different rate. Again, there's a arbitrage. You buy from the futures and sell it in the spot, or buy from the spot and sell it in the future. The last day it would be the spot. So at the beginning, assume spot is fixed. At the beginning, it may be futures price may be higher than the spot price in a contango. But what would happen with time passes? This will gradually come to what? It may not be a linear fashion. Same thing would happen in a backwardation market. Even though it's at a lower level, on the maturity date, this should gradually come to the spot. That is we call convergence. Converge to the spot price. Clear? Then by on the expiry date, the cost of carry is 0. Net cost of carry is 0 on the expiry date because you don't carry it. Just buy or sell and settle it. That's it. You don't carry that position. So therefore, net cost of carry is 0. That's why futures price equals to the spot price on the expiry date. So then that process we call convergence. Then there's another concept called basis. What is the basis? Remember that the difference between cash price minus and the futures price, and again it's cash price minus futures price. Remember this. very clear. Basis is cash price minus futures price. So in that scenario, in a contango market, basis, is it positive or negative? Negative. Why? In a contango market, futures price is higher than the spot price or the cash price. Futures price is higher than the cash price, so therefore this difference is negative. Contango market, basis is negative. In the backwardation, then basis is what is the basis? Basis is the difference between this cash price minus the futures price. Then you know, in a contango market, futures price is higher than the cash price. In a backwardation market, futures price is lower than the. Therefore, in the contango market, basis is negative. In the backwardation market, basis is positive.
Technically, cash price and spot price both same.
Yes. When it comes to futures, cash price means whatever, whether it's bonds, it may be T plus 1 or T plus 2. In FX, it's the spot price. If there's any marketing settling T plus 3, that's T plus 3. That is cash price. Generally. So this is the graphical representation. This is cash price. This is futures price. The difference is basis. With the time, cash price and the futures price may behave differently. Here you can see spot price has increased, but the futures price has decreased. Then both together decreased, again increased on the expiry, both are, but the gap generally gap narrows. That is conversion. Is it a positive gap, positive basis or a negative basis? This graph, does it show a positive basis or a negative basis? Positive. What is the basis in this graph? Is it a contango market or a backwardation? This graph shows a relationship between cash price and the futures price. Is it in the contango market or the backwardation? It's a contango market. Then the basis is, remember, futures price lies above the cash price, then basis is negative. So there are some markets like this is a crude oil futures that may be traded in a contango market. But there are some markets, some underlying futures are traded in backwardation market. But in some it may change time to time. First two things are. So whether it's a backwardation or contango market, with the time basis get close, convergence happening, get closer to zero. Then in a perfect market, the basis should reflect the cost of carry. The difference is the cost of carry. But market may not be perfect, so there may be differences.
What do you mean?
That means, as I mentioned earlier, the information distribution, taxes, whatever frictions, bid offer spreads, all those matter. Other causes or reasons for the basis to change. First thing is supply and demand. Supply and demand of underlying asset as well as for the futures contract. Then the changes to the cost of carry. When we say changes to the cost of carry, depending on the underlying asset, cost of carry may vary. It's not only interest rate. There may be some benefits, coupon or dividends, or there may be storage cost, insurance cost, things like that. So whatever the changes happening in those, that will change the cost of carry and the time remaining to that convergence occurs. What is the risk of this basis? We use futures contract to hedge our position. So you want to buy something, not today, in a future day. Go back to an example how to use futures. Okay, if we take our CPC, we need oil. We need to buy oil. Towards the end of the year, what would happen to oil prices? The global market, not local. Why? Generally, towards the end of the year, oil price increases. So, if you have to buy oil, you have to pay high price. How can we avoid that? Instead of waiting that December or next January, we can enter into a futures contract to buy. Today we will fix the price. But still there will be a price add-on because since we know that in the winter season oil price going up, everybody will try to buy futures, then the futures price goes up. That can happen, but still we can fix it. So that's hedging. We fixed our price to buy oil in December. But the thing is, say now the spot cash price of oil is $50. Futures, December futures is $60. What's the basis? What's the basis here? Cash price of oil barrel is $50. Futures December futures price is $60. What's the basis? Minus 10. Thing is, say after 1 month, this may be 52 cash price. What do you expect for the futures price? Would you expect it to be 62? It may or may not. It may be 65 or 58. Anything can happen. You can see that this is generally convergent. So, this is the risk we call basis risk. The basis may change during the lifetime of the futures. So therefore, your hedging transaction may not exactly match your Bitcoin. Your ultimate risk profit or loss may not be zero. There will be a difference. So therefore, when you do futures transactions, you have to think about this basis risk. Why this basis risk happens? Not the cash price and futures price moves 1 to 1. When the price cash price increased by $1 or 1 rupee, futures price may not go by 1 rupee or the 1 dollar. Maybe by a different, depending on several. So therefore, that risk, the basis changes during the lifetime is called the basis risk. Only way to get out, to hold it until maturity. Why is that? You had 50, 60 here. The difference is 10 basis points. On the maturity, what happens? If oil barrel price is 55, price of oil barrel 55, what would be the futures price? That this also will be 55. Then your profit or loss would be difference between this futures price and this spot price. You match exactly that. But what happens in futures contract? Say you want this oil in, say you want oil in December 15th, but there may not be a futures contract to deliver oil on 15th December. We may buy a futures contract which deliver oil in 30th December or something. Whenever we want oil 15th December, what they have to do, tell the futures contract that we have already get that price. By that time, we may not get the what we expect at the beginning. So that is called basis risk. There are two more concepts. Arbitrage, I explained. The other two concepts I think I have dropped. That is called futures strengthening and weakening. Strengthening and weakening basis. So it's about whether the basis narrows or widens. Sometimes basis may be widened, sometimes basis may be narrow. Depending on that, we call it strengthening or weakening. So, yes, initially I thought it would be too much for you, so I will remain same. I won't discuss this. Just remember, there are two concepts called strengthening basis and weakening basis. Apart from that, everything else, not everything else. Most of the things in the presentation I discussed. Even arbitrage, I discussed. In arbitrage, there are things called cash and carry arbitrage. That's the one we discussed. Futures is expensive, so you sell the futures contract, buy the underlying, borrow funds to fund this position, cash and carry. You buy the asset in the cash market and carry the position. Then the reverse cash and carry is the second arbitrage trade that we discussed. We do this when the futures is undervalued. We buy the futures from the market and here sell the asset, basically short sell and borrow the asset. And invest the selling proceeds. That strategy called reverse cash and carry. The other one, buy the asset and hold it, is the cash and carry arbitrage. We discussed this, but I didn't mention these two names at that time.
Summary, can you remember this as long and short? Cash and carry long and short.
But you have to be specifically remember what is long, what is short. If you long futures, that's other way around, because here you are long futures, here you are short, but you are long the asset, short the asset. So you have to, whatever the way, you can find out ways, but be specific. What is long, what is short. But instead of that, my suggestion, compare the prices, theoretical price or the moderate price and the market price. Then think, what do? You have two things. One is same thing at two different markets. One is at a higher price, other one is lower price. What do? You sell the one with the high price. So then go back and think about what to do. If you sell the futures, what is your obligation in the future? You have to deliver the asset. To deliver the asset in future, Today you buy it and keep it today. To buy it, you need funds. How do you find it? Or if you have already bought the future, you will get that asset in the. So you have to create an obligation to deliver that. So sell it today. You don't have as I said, borrow the asset. Borrow the asset, sell the asset. Then once you sell the asset in the cash market, you get cash. What do you do with this cash? Invest it. Don't keep it. Invest it. Then, so remember, my suggestion is to remember it that. You just remember few long or short or whatever. Ultimately, you don't know what is you are long on what. You don't know. The future so the you want me to go through this again arbitrage rate. Cash price is given. The barrel of crude oil is currently traded as $103.75, and the futures is trading at 109.34. You can borrow dollars at 2.5% per annum. Calculate the fair value of the 1 year futures contract. Calculate the arbitrage profit. That means it clearly say there's arbitrage profit. To get that, the fair value should be something else or should differ from the futures price of 109. So you should get something else. So do the calculation. 103.75 is the cash price. This is the cost of carry. That means you have to buy a oil barrel today. You have to spend 103.75 and hold it for a 1 year period. You incur the interest cost, assuming no storage cost. So 106.34 is the interest cost. So that's about what to do next week. So as I mentioned earlier, we'll see what are the developments. If the curfew imposed all over the country, nobody will be able to come here, so there won't be even online class. In that extreme scenario, we won't be able to do that. So if the situation is somewhere in the middle, so better you stay at home. You can have the online class, but if you think it's okay, we'll have the class. We'll let you know through the Google Class. You just check it. So the futures price, theoretical price is 106.34, but the market price is 109.30. So there's a $3 difference. What is our price? Futures contract for the month. Futures contract is 109.34. Theoretical price is 106.34. That means futures is overpriced. Then what do you do? Sell the futures. If you sell the future, what do? You do the cash and carry arbitrage. That means you buy the asset from the cash market and hold it until to buy the asset, you need funds, you borrow from the market at the market interest rate. So what is the arbitrage profit? Once you do these calculations, futures price, theoretical price and market price, you don't have to think about what to do to hedge for the explore the arbitrage. Still you can calculate what would be the arbitrage profit. What is the arbitrage profit? The difference between existing market futures price and the theoretical. So $3 in this section. So these are the actions to be taken. Buy the asset now, borrow funds, sell the futures. This is another example. You are given the current cash price, fair value for future, and the current futures price. Cash price 1,450, fair value for futures 1,485, market is 1,497. So market is overvalued compared to this. Market is overvalued. Sell this, buy the asset, borrow funds. Cash and carry. So what's the profit? Arbitrage profit is the difference between 1,497 and 1,485. The difference is $12 or 12. When the market price of the future is less than the theoretical price, then the market is undervalued. At that time, we follow the reverse cash and carry trade. In reverse cash and carry, what you do? Buy this, buy the future of the market and the market price, then sell the underlying asset. To sell the underlying assets, we need to borrow the assets, whatever the selling proceeds, invest at the given interest rate. Clear? So that's it. Then at the end, as I mentioned, it's not easy. There may be other factors. There may be transaction cost. When you buy the asset, you have to pay a commission, even for futures. We have discussed for futures, there's a commission that you have to pay to the futures brokers and bid-ask spread. So when you factor those things, if your commission is more than the arbitrage profit, it won't work. The bid-ask spread are wider than the arbitrage profit, you may not be able to explore the profit. Therefore, based on these factors, there will be a thing called arbitrage channel. What does it mean? Within that channel, fair value may, or there may be a difference between market value and the fair value. This is the fair value. Theoretically, based on the given prices, you will get this price. That's the theoretical fair value of the futures contract. But the market price can be in between these two bands. But still, nobody will be able to explore the arbitrage because of the commissions and other transaction costs. practically there will be a channel within or a band within that futures price may deviate from its fair value, but there won't be any arbitrage opportunity. Practically that could. So I think that's it. Let's keep that basis. Any question? So we will stick into our plan. Next 3 weeks. 3 weeks regulation, but again, I feel like if it is online, you may finish in 2 weeks. That is it. What I experience in online classes is 2 weeks. It's not because of that. I am speaking too fast. You know, I cannot give time for you to answer the questions and things. That interaction is that. So therefore, that's the tendency. After in this class, everybody says moving fast. So that can happen. Otherwise, 3 weeks for the regulation, then we will start prediction. Four, 11, 18, 25th. Then first, I'll ask that first 2 weeks to Perry. Most probably, I'm not sure whether Perry will be can a I'm sure whether Perry will be in Colombo. If not, we'll have to skip that day. I'm not. If he is not available, we'll skip that. Then from 8 onward, we'll have 4 revision classes. I don't know how Perry would tackle revision classes, but my style. So you come up with questions, you do study, you ask questions, I will answer those questions. While answering those questions, I will remind you these are the concepts behind that. But I don't want to go through each and everything again. What we discussed for these 20-30 weeks, we cannot discuss everything again in 2 weeks. You do your homework. Try to address the most difficult parts that you start going through the basics. You need basics. If you don't understand basics,